Right. Good evening, guys and gals. See what I thought I will do. This is a presentation. Nari gave it to me, and I thought this is a good starting point to discuss. And then we will go through some examples of putting together trade, and that then I will actually show Thinkorswim platform screen, and then we can probably take a look at that. So today I wanted to kind of talk a little bit about iron condor and iron butterflies generally, and then from there I will go and start discussing a little bit about um, verticals, calendar spreads, and diagonal spreads, and mainly to discuss about how to make adjustments to existing positions when the existing position goes against you. So that's the idea. So we'll go over that, because a lot of times when you sell a collect call, I mean a covered call, or when you make a trading position or a vertical or whatever trading position you take, it can go against you. You expect the market to go to one point, maybe it goes to another point, or even on the plus side or on the minus side, sometimes you have to make adjustments to your trade. So we will go through the adjustments. So the first thing I wanted to kind of talk about is iron condor. This is a very interesting strategy. Uh, it's an income generating strategy. It's a pretty simple strategy, even though there are multiple legs to this. So we will go through that, and then it is easy to understand what it is, and then we can figure out at what point in time it makes sense to go through that transaction. Just as this is a disclosure that options are a very risky investment strategy, and we all know about this. And we are using a presentation that Fidelity Investments has put together. I'm just borrowing that what Nari has given. An iron condor is basically two verticals. I don't know how many of you know what a vertical is. A vertical is you create a spread, that is, you buy a call or a put at one point, and you sell a call or a put at another point, and the spread is the money that you can make. So for example, if you buy a put at 95 and sell a put at 100, $5 is the maximum money you can make. But when you make this trade, you may get $2 or $3 out of the trade, and you may get to keep that if the price falls within that range. That's the idea. So here in this particular trade, what happens in order to put together an iron condor is you buy a put at 95, you sell a put at 100, and then you sell a call at 105, and you buy a call at 110. So there's a $5 spread on the put side and a $5 spread on the call side, and the premium you will receive in this particular example, he is putting a net premium of $2.80 is what you receive out of the $5. So your maximum loss is going to be $5 minus the $2.80 that you have received. So it's about $2.20 will be your maximum loss, as it is shown here, if the price of the underlying share goes below 95, or if it goes above 110. In both the cases, you will have a loss of $2.20. But if the price stays between 100 and 105, this $5 spread here, if it stays that, you get to keep the $2.80 for yourself on the expiration date. That is the concept of iron condor. That is, you always sell an iron condor, and when you sell an iron condor, you are getting a premium on a bull put. The bull put is on this side between 95 and 100, and a bear call is between 105 and 110. So you sell a bear call and you sell a bull put to collect your $2.80. And then if the share price remains between 100 and 105 on the date of expiry, you get to keep the $2.80. That is the basic concept of iron condor. The only way you should get into this position is if you have conviction that the current price of the stock is somewhere in between 100 and 105, and you think the price is not going to change between now and the expiration date. That's the idea. If by the expiration date, if you expect the price to remain between 100 and 105, it's a neutral strategy. You think it is going to stay there, then you go and sell an iron condor. Your risk of the trade is if by that time, if the price drops below 95 or goes above 110, you're going to lose the $2.20. That is the basic iron condor. Many of you may know about it. If any of you have any questions, please feel free to interrupt at any time and ask me. I've done this many times before. I don't do this anymore, especially in this volatile market that we have today. To make a risk, even a 10-day or a 20-day expiration, this is very risky because the market is wildly gyrating, 10% up, 5% down, 5% up. It's wildly generating. In this kind of wild gyrations of the market, the wild gyrations of the market, there is really no way you can make money on iron condor. It is too risky. But if you think iron condor is where you are going to make money, you can certainly get into this, especially if you buy indexes which don't move that much as a stock does. So on index, you can make money on iron condor by putting together a position in a short-term window, maybe 1 week, 2 weeks, 1 month, 2 months. It is a short-term income strategy. And I want to make one other point here, that when you collect this $2.80 net credit, that's not free for you. So you don't have to have a stock position to get the $2.80. However, they would require you to have $5 per share on the margin side. So this is almost like a cash secured put. So when you sell a put, you have to secure that selling of the put with the cash. So here it is very similar. And when you sell an iron condor for $2.80, there will be a margin of $5. If you don't have a margin account, I don't know whether they will even permit you to sell an iron condor. If they do, you have to have a cash of $5 per share to be able to sell that $2.80. However, it is much smaller amount that you would have to pledge on the margin side compared to a cash secured put. So in many ways, this is an income strategy with very little margin money that you would bet on, especially if you are very confident. Let us say an index like SPY. If you think SPY is going to trade within a 10-point or a 20-point range in the next month, if you have the conviction for that, then you can go ahead and sell an iron condor and make some money out of it. So we will go through the example of that in the Thinkorswim platform.
Bala,
Yeah, go ahead.
So the recommended expiration date period is about 30 days approximately, you said, or anything that's
I would
standard?
say 30 days, 2 weeks. See, it depends on your conviction. Okay, the longer the period, the more credit you can get.
Right.
So if you sell for 1 week, uh, you may get uh, $2. If you sell it for 2 weeks, you may get $2.80 for the same spread. But sometimes you can get a better spread. For example, if you're going to sell it for a month, then instead of a 100 to 105 spread, you may be able to get a 95 to 110 spread. So instead of 195, you could sell 95.90, and then instead of 105 110, you can sell 110 115. Then for that longer, bigger spread, if the spread is bigger, the credit you will get will go down. But if it is 30 days longer, if it is for 1 month, you will get more credit. So if you give it more time, you will get more credit. If you give it a narrower spread, you will get more credit. If you want higher spread, which means lower risk, you will get less credit. That's the way the math works.
Okay.
You follow?
Yeah, I get it. Yeah.
So it's a very simple strategy. One vertical on the put side and one vertical on the call side. All of it taken at the same expiry date at different strike prices. And as you know, let me just give a little background on spreads. You can have a call spread for both bull and a bear spread. Similarly, you can have a bull put spread and a bear put spread. So here, put and call are kind of the same thing. You know, one is not a bull and one is not a bear. In this particular case, a bull spread is put on the put side to collect a premium. So when you collect a premium on the bull side, you will put it on the put vertical. On the bear side, you will collect a premium if you put it on the call side. That's the only difference. So there is really not a whole lot of difference between call and put. But iron condor is a strategy in which you get a credit for both the bull spread and the bear spread. But if you just go for regular condor, which is not an iron condor, a regular condor is done all on the call side. You sell a call spread and you buy a call spread, and similarly you sell a put spread and sell a buy a put spread. So if you do that, that is called condor, in which you will have a neutral strategy. You will not get a lot of credit. You will get a minimal credit, maybe zero credit. But then, depending on what happens at the end of expiry, you will get the $5 to you. So that will be a regular condor versus iron condor, where you collect everything all the way up front. So the premium received is the maximum gain you can hope to get. So the $2.80 is the maximum gain you can hope to get out of the transaction. And you can lose the difference between what you got, 280, minus the spread, which is the $5 spread in this particular case. So that is generally iron condor. So if you have any questions, I can answer. Otherwise, I can go to an example.
Why is it called iron?
Iron is just a spread on put and spread on call is called iron. If you take out the iron, then the spread, all the four buy, sell, all of them are all on the call side, is called condor.
See, no, I'm just asking about the semantics of the name. No, like
Yeah. I'm telling you.
It is called condor because it looks like a bird, right? So that is
Yes,
why it's
yes,
called
yes,
a
that's
condor.
right.
The profit curve. But I
Yes.
was just wondering why. Why is this called the iron condor? Because it doesn't move much. I don't know.
No.
Maybe.
I don't know why. Maybe we have to do some research on that. I don't know why it's called that. But it is called iron because one is on the put side, another one is on the call side. You can have the
Right.
same diagram all on the call side or all on the put side. You can get the same effect.
So,
So,
like how do you I don't know whether this presentation or you from your practical experience, so how do you select the stock, like are there any selection criteria, and also like you have like delta and other things.
Yeah, any other parameters that you look for? Like, you've suggested few
See,
things
these
before.
are
Yeah.
the you can go to delta based trading, but this is not a delta trading strategy. Iron Condor. Iron Condor is what is generally known as a neutral strategy, which means the net delta is zero. So the net delta, see, net delta is as close to zero as possible, which means that if the current price of a stock is say 450 and you take an iron condor between say 440 and 460, that means that $20 spread is where you think the price of the stock will remain at the end of the expiration, then net delta will be zero if you do an iron condor. So this is not a delta strategy. This is it happens to have a zero delta at the time of entry into the strategy. So you don't pick your range um, based on delta. You pick your range based on where you think the price will be in the next 30 days. So see what I'm saying?
Yeah, the delta is definitely neutral. It balances out.
Yeah,
So,
delta is
but
balances out.
yeah, but I was just wondering whether he has given any like how to select which stock we should select, volatility, any.
Typically you do not pick high volatility stocks. The higher the volatility, the risky the trade is. You want even if you pick a high volatility stock, you expect the volatility to go down. Like for example, if the volatility, implied volatility is say 30-40%, then you go and take an iron condor or that 40% implied volatility for that particular expiry date. And then you expect the volatility to go down. Let us say the war is going to end tomorrow, you have some secret information, and the volatility is going to go down or go up, whatever it is. But if the volatility is going to expect it to go down, then iron condor is a very good strategy. The idea here is you want your volatility to be going down, because when the volatility goes down, the options premium will go down. When the options premium go down, you can buy back the iron condor much better. You sold iron condor, you can buy back the same iron condor with the same risk price at a lower price, and you can make the difference in money. So with time, you would get both the theta and the vega if the volatility is going to drop. So this is a strategy that you don't want to get into a strategy when the volatility is high. You want the volatility to be stable for the next 30 days on a particular index. Let's say the earnings is out, earnings period is over. Now we are sitting in the first week of March, and there is no war, there is no real thing going on. It's all boring, nothing is happening. Then iron condor is perfect. Obviously, it's not the situation now. It's not boring. It's all very interesting. If it is too interesting, then iron condor is pretty risky, because
Correct,
it may look
correct.
like you get a lot of premium, but then the risk of losing the money is much higher.
So you mentioned that iron condor is primarily for selling, right? Is there like a buy iron condor?
Normally, you don't buy iron condors. Normally, you sell iron condors. The whole idea of iron condor is let me just talk about another principle. An iron condor has got four legs, right? in these four legs, let us say one of these legs is going to be broken. Like for example, suddenly there's a breakout and you expect the stock to run to $120, which means you're going to lose in this transaction. Now, in that situation, when the thing goes high, now this 110, you have bought at 110. You sold 105 call, but you have bought the 110 call, right? At that time, when it looks like let's say the expiry date is 30 days. 10 days into the trade, you just realize that you were wrong about it, and suddenly you think the stock is going to just move because something happened, some acquisition, something is coming up, and you have a reason to believe the stock is just going to go up. Then you can just buy back this leg, this 105 leg. You can just buy it back, pay the price and buy it back because you already got some credit for it. So use that to buy it back. Then this 110 will just fly and you will make a lot of profit on that leg. Those are the reasons why you would get into Iron Condor as a selling strategy. If you want to have a buy, then you don't buy an Iron Condor, you buy a Condor. Then you buy a Condor, then you can have the same strategy. You will not get the money up front, you will get the money upon expiry. Just like you buy any call. You buy a call, you spend money to buy a call, and then when the expiry date comes, the call value is much higher, and you sell the call to make your profit. You can do the same thing, but if you're going to do that, I probably would not recommend buying an Iron Condor. I would probably recommend buying a Condor because Iron Condor is for a particular purpose to get net credit. See, because here, if you look at it, you look at this transaction. See here on the put side, you bought something for 70 cents and you sold something for 210. So you got about $1.40 out of this, out of $5. So if you're going to lose this put vertical, you're going to lose $3.60 right on that. But either you're going to lose on the put side, which is below 95, or you're going to lose on the call side, which is above 110. You are going to lose only on one end of the stick. So the other end is going to be free money. So here on the call side, you sold something at 235, you bought back at 95. So that's around 140 also. This 140 is the gain that you have had on the call side, and you are guaranteed to get this 140 or this 140 if you sell an Iron Condor. When you buy a Condor, you will sell one leg and you will buy another leg. Your net credit will be zero. Then it is not generally considered an Iron Condor. You see what I'm saying?
So another thing I read was iron condors typically have a very high percentage of profitability, like 70-80%. So if you are on the other side, then you have a chance of only 20% of making money. Right? So that is another reason you don't buy an iron condor.
Yeah. Iron Condor as a strategy typically is a selling strategy. I don't necessarily agree with that statement, Nari, only because the way it works is, like let's say on the put side, you may have a 70% chance of winning. And then you may have a 70% chance of winning on the call side. But you cannot say you have a 70% chance of winning and 30% chance of losing. Actually, some people will argue this 30% chance of losing on the put side should be added with the 30% chance of losing on the call side, and your loss potential is still 50 to 60%. So,
but if your loss percentage probability is 60%. Why would you trade? Because consistently, if you keep trading, you lose money. No.
That's why a lot of people, I don't think Iron Condor is a sure bet. Iron Condor,
No, this is what I mean. This is what I read in a book, saying that the main reason you're trading in Iron Condor is got overall it has got a 70% profitability of profit.
I don't agree with that. I
Okay.
typically don't agree with it because I just think that they are taking a look at only one end of the stick.
No, this is the total thing. I will send you something later.
Yeah, you can do that. But typically, I want to tell you my experience with Iron Condor is it's a 50-50 strategy. It's a bet which has got a 50% chance of winning and 50% chance of losing. Because options generally, if something gives you 70% chance of winning all the time, everybody will be doing that. And then the market will break down. No, I don't really think so. There is no strategy in options which is always going to be 70%. Maybe some marketing guys are pushing that theory. They want you to get into these things. My general recommendation for Iron Condor is this: do Iron Condor in a low volatile environment, do it on indexes rather than stocks, which are more volatile than indexes, and do it when things are a little quiet and we have a boring situation and the market is generally moving. But if there is a high volatility environment like what is going on right now, where one day it's up 600 points, another day it's down 500 points, it is just going up and down like that. This market, it is very difficult to make money on Iron Condor. This is my opinion. Of course, anybody can differ with that, but I'm willing to listen. But generally speaking, uh, the theoreticians sometimes look at this percentage of winning on the put side at 70%, percentage of winning on the call side at 70%. They say net it's 70%. Actually, I would argue the lose percentages is what should be added up and to say that there is an equal chance of losing. But I could be wrong. Some people perception is different. But I can tell you honestly, 100% of option traders are not doing Iron Condor every day to make money. Iron Condor is a money making strategy under certain circumstances. When you have good conviction, you can certainly go into it. I don't do this anymore that much because the markets have become very volatile. In these volatile markets, the leap strategy with covered calls against those poor man's covered call against leap is really a best strategy. But anyway, we have to know what Iron Condor is. Everybody should learn what Iron Condor is so that they understand it fully, and if they find it suitable for them, they can certainly do it.
Hey, Bala, just one point on answering Nari's question. Nari, the profitability, I don't know how somebody has conveyed that message or where you heard that, but I think the profitability in iron condors will depend on how wide you make it and how big is your spread. I think those things would drive your profitability. Obviously, volatility will also affect it, but versus if somebody says that, hey, 70% it's going to make profit. No, if I have it too narrow, then it's not going to make 70%.
Exactly.
So I think what's going to drive your profitability is how wide you do the condor, the flat line that you see on the top, how wide that is, and
Yes.
how tall is that spread. I think that will also drive your risk reward ratio. I mean, if you do those things, if you play around with it, you'll see that. Versus
Correct,
somebody
correct.
saying that
So
70%
yeah,
is going to
no,
make profit,
that's
right?
exactly what I'm saying, right? See, obviously, I'm not saying that you decide on any strike price and it'll turn out to be 70, right? So what they are saying is you do the transaction for Iron Condor by playing around, and at least you see, because the trade, when you do the analysis, it gives you the probability of success, right? So that
Yeah.
if you
So
follow the particular
But
things,
one point I would make, Nari, is this: is that it's a very subjective thing what you are really talking about. But one point I would make is that if you take less credit, like in this particular case, he's taking a credit of 280 out of $5.
right.
But if you take a credit of only $1 out of $5, the probability of success of that $1 will be much higher. It is something like selling a 35 delta call, covered call versus 20 delta covered call. The 20 delta covered call is going to give you less premium, but better chance of in the money, better chance of out the money compared to a 35 delta call, which is going to give you more premium, but a higher chance of, you know, going in the money. So similar to that.
Exactly. So I think when you make it wider, what you'll see happening is you're going more and more out of the money. And that's why both your legs, the sell and buy of put and call, both those, the premiums start reducing as you go wider on the top part. And
Yeah, you
that's when you're
minimize the risk, minimize reward also. Yeah.
yes, that's what exactly it is. Now, the other thing I think I mean, couple of things important. I've played with iron condors quite a bit, which is why I'm contributing here. Other thing to also look for is you're paying every time you're setting it up, you're paying 4 legs of commission. And if you're closing it down, then you're paying 8 legs. I mean, 8 times you're paying commission. So I think commission does make a difference. And I think what's more, I think Bala, you were saying this earlier that to set it up in this particular example, they probably need not margin, but they need 5,000 cash in your account because that's the spread that you have. So
Yes.
as long as you have 5,000 in the account, you can sell one of these positions. But what will happen is if the market is moving on the higher side or lower side, and if the stock price comes in that diagonal on the left or the right, they will force close the position because now you don't have money. You may not have money to take that assignment in your account. So they will force close the leg that's closer to, I mean, at closing, say, for example, the stock is going down and it gets into that left side of slope in that spread position, they will force close it before in the last half an hour or whatever, because you may not have, potentially you're looking at an assignment and you may not have that much money to cover an assignment. So those are risks that you're carrying. I mean, that you have to understand.
Yeah, my suggestion is you should be prepared to pay the commissions, and you should be really prepared to um, prepared to take a chance. Like when the thing moves like that, in my opinion, when it comes closer to the slope, that's when I was saying, if you think it's going to go further down this way or further down, further up that way, the sell part of the thing, you should buy it back and take a chance with the thing. You should be prepared for such strategies to make adjustments before getting into iron condor. So in my opinion, this is not a simple make money income generating strategy. It's got to be a little bit more careful about it, and the market conditions also have to be uh, apt for this. And generally, I would propose the go and do on indexes.
Yeah, Bala, one other thing before I shut up is
No,
I,
please go
I,
ahead.
I, I I have also done inverse iron condor. So exactly like this, but flip it around, other way around. So you make more profit when the stock is outside that middle band. And that has given me more profit. I was playing with all these things when I was learning. This was 4 or 5 years ago when I was first learning options. I set aside some money and I said I'm going to play with these strategies to just understand. And
Good.
that's when I found that the inverse iron condor worked a lot better, especially with stocks like Tesla, where there is a lot of volatility. I made a lot of money with those inverse iron condors. There may be a different name for it, but I call it inverse iron condor because it's set up in such a way that it gives you more profit. It gives you profit when it's outside that middle band.
Yeah.
So it looks upside down in iron condor, and that could be your answer. I mean, if you think that the stock is going to be very volatile for whatever reason, it's not going to stick into that middle band at expiry, then you set up an inverse iron condor, and then you can, so there are ways to tweak this, but it is a complex strategy and you need to understand this fully before you get into it.
I think the main thing you have to understand, my opinion is, you have to understand the verticals. If you understand the verticals very well, and then you can create your own legs and inverse iron condor, or you can do back spreads, or you can do wider in one direction and narrower in the other direction, based on your conviction. If your conviction is this is going to wildly gyrate, Tesla stock is going to wildly go between 800 and 900. At the end of the day, you must have an expectation about where the stock is going to go from what point to what point. And based on that, you can put together your own spreads also, which will be very good. But for that, you have to understand the main concept of a vertical, whether it's a put vertical or a call vertical, whether it's a bull vertical or a bear vertical. If you clearly understand those things, then you can form your own ideas as to how to put together these strategies. Anyway, I just want to kind of go to the butterfly, which is not a whole lot different from iron condor. We have already covered iron condor. Butterfly is just that top end of the spread. In the iron condor, we had a spread between 100 and 105. In the iron butterfly, they are both 100, as you can see here. So iron butterfly is just that you sell two in the middle, 100 put and 100 call you sell, and then you buy 105 call, and then you buy a 95 put, which is somewhat like iron condor, except that it is called butterfly because the diagram looks like this. This is the profitability diagram that looks like this. So that's the only difference between iron condor and iron butterfly in terms of strategy or putting together a transaction. The advantage of iron butterfly is you get more out of it. As you saw here, the net credit is much higher. You got almost $3.90 as your credit. Your loss is going down. In a similar situation, this is kind of saying, when you come narrower and narrower on the top side, your credit is going to go higher and higher. Your risk is also going to go higher because the profitability is going to change. In the other one, it was here. Well, in this diagram, they're showing it in the same spot. But technically speaking, what will happen here is your break-even point will get a little narrower on the iron butterfly compared to iron condor. Basically, iron butterfly is slightly more riskier strategy, but you get more credit. Okay. Now, do you guys want to go and take an example?
Yeah, that will be great.
Okay, let me go to. Are you able to see the screen?
Yeah.
Okay. Now, on the trade window, I put together a trade on Lockheed Martin, which is at 450 today, and I put together a call spread, out of the money call spread between 470 and 465, and then an out of the money put spread between 430 and 425, and you got a beautiful credit of 445 for that spread. If you think by 14th of April in 43 days, you are going to have, are you able to see the screen, or is the thing too small?
Yeah, it is too small, but we can see it.
Okay. Let me go to look and feel font size. Okay.
Yeah, this is better.
Okay. So basically what happens here is, oh, I don't know what happened to the fourth leg here. Okay. For some reason, it's showing a little less. Okay. So this is what I set it up before coming into this. So you get a pretty good credit of 445 out of, so the loss here, the loss is very, very less. And if you analyze the thing, you have 500 for a 10 contract situation, you have a $500 loss potential, but you have a $4,500, near $4,500 profit potential if the stock price is going to stay between 430 and 470 by April 15th, which is the expiry date for this particular transaction. So this is one way to look at it in a live example where you see, and then here, if you look at the probability analysis, this is what they are probably talking about on 415. So you say that, hey, there is a 15% probability here and 15% probability here, and that's why they are saying, so 15 plus 15, 30%, and you have a very good chance of being in the range of 70% probability of winning.
Correct.
That's what they are probably talking about. But then, if you really think about it, this stock is highly volatile. The implied volatility is like 35%. Even though you get a lot of credit here, maybe Amrish can tell us, will this be a good trade, Amrish?
Well, I think if the volatility is high, then I would say I would question how you're probably too narrow, which is why you're getting that high 70%
Yeah.
thing. You're definitely narrower than what yeah, especially a month out.
Yeah, usually you're narrower, right? So you now need to widen this. We'll go to, let us say, instead of 430 and 425, let us go for say 405 and 400 on this side. Say suddenly the thing dropped from $4 to already $2, and then especially if you go on the other side, 470, let's say 490, and 485. So the credit has dropped to like 70 cents. Here, you have a big chance of losing, but you have a wide spread of between 405 and 490. So the chances of the stock falling within that price range is pretty good. But you get only 70 cents out of a $5 spread. You're not really getting a lot of credit. So, but you are carrying a $4.30 risk if it goes outside of this. So, in some ways, is this what you want to do? That's a question that you must ask. But if you think this is what you want to do, then Iron Condor is definitely for you. Amrish, do you do a lot of Iron Condors nowadays? Having trading in options for 5 years, or you have zeroed in on your own strategy and that's what you repeat?
Yeah, no, I don't do, I'll be very honest, I don't do iron condors nowadays at all. I
Yeah.
used to do that. And as I said, I made more money with inverse iron condors versus the iron condors that look like this. The one that look opposite, I've made more money. But I've given up on those strategies because I feel there are other strategies which make, as you were saying, the poor man's covered call is much better, and
Exactly.
other strategies are much better than this.
Yes, much better. That's what we talked about, that delta based trading strategy, that's better. But from an options education point of view, everybody should know what iron condor is, what iron butterfly is. I think it's a very good thing. If you don't mind, we are running into the time. I do want to spend a little bit of time about talking about adjustment strategies. So adjustment strategies are basically when you buy a leap, for example. Let's take a leap on, let's say you bought a leap on, say, Lockheed. So you are sitting, let's say you bought deep in the money leap, let's say here, I'm just going to say 50. So let's say you bought deep in the money leap when you bought it, let's say it was 85 delta, and you bought deep in the money at 330, and you spend $129 to buy that leap. But now, let us say the price has moved up. Lockheed moved up in the last, because of the war, the Lockheed moved up like 50, 60, $70, and that leap is now going to be worth a lot more, and the delta of the leap would be now 90 or 95 or something like that. When the delta goes up to 95, and when you're sitting at, say, when your optimal strategy to collect a poor man's covered call on that is, let us say, between 80 to 85 delta, it makes sense for you to roll it back and take money out of the position. That way you have the cash available to do other things, to maybe buy more contracts on the same stock or some other stock. So one of the adjustments you would make is what I would call as a vertical. You sell a vertical. So let us say you bought it at 330, and now the price of Lockheed Martin has moved up from 450 to say 490, something like that. Now, instead of 300, a option strike price of 390 would be at 85 delta. So you would have moved from 85 delta for 330 from 85 delta to 95 delta, let us say, for sake of argument. Now, when you move it like that, then you sell. So you sell that position and then you buy another position at 85 delta. That is one of the adjustments that you can make to your position to make money out of the profit that you have made on the leap. Of course, your tax strategies or long-term gain strategies, those things will be affected. But assuming that you're okay with short-term gains, that strategy of selling a vertical and to collect money out of it. So from 330 to 390, $60, when you move, you may not get all of the $60, but you may get $55 out of it, or $53 or $54 out of it. You can get it. You get that money, and then you can use that money to buy other shares, and then you can move it down to that 85 delta. So you are still in an optimal delta position only if you continue to think Lockheed Martin is going to keep going up and up and up. So your continuing strategy is to keep on the position. You still think it's going to go up from here. One of the rolling strategies on the vertical is to do a vertical. So a vertical strategy is you can do a vertical on either way. Either you can go from a lower delta to a higher delta on what you may have sold in the call, or if you are bought in a deep in the money call, then you can go to a lower delta from a higher delta, and you can sell a vertical or you can buy a vertical. So that's one way you can adjust your position. Similarly, when you have sold a covered call, let's say you are sitting on, say today is March 2nd, so you have sold a covered call, let us say for sake of argument, you sold a 455 covered call at $5.85. However, the call has moved forward, and the price has become 490, or let's say not 490, let's say the price has become 465, and it has become in the money, and the price of whatever you sold at 580 is now worth, say, $12. It has moved $7. Now what do you do now? One of the things you can do is to roll it on the calendar spread. So that is called a calendar spread, where you roll from your current position. So you can do the same. If you think the price is going to come back to the same 455 where you sold it, you can do a calendar spread from 4th March. You can create a rolling strategy. Well, if you are in a position, okay, only in a position you can do that. You can just You cannot roll from a fictitious position. You have to roll on an existing position. Let me see whether I have any existing trade out there. Okay, in this simulated one, I don't have an existing trade. But if you have an existing one, the rolling will be possible. So basically what you're going to do is you're going to buy back that 455 option and sell the 455 option maybe a month from now or 2 or 3 weeks from now, where the premium will be higher to pay for the $12 difference that you just now paid, and then you can get some more time out of it. You can maybe collect some premium out of it. Hopefully the price will drop to 455, even though it has now popped up to 465. You hope the price to drop in a week or two. You just sell a calendar spread. That's one way to adjust when the position goes against you. So if anybody has any questions about that, how to do that, you may be doing it already. I'm just saying an adjustment strategy is something that you should know. Any questions?
It's probably the most important strategy that you should know, I would say.
Yeah, it is a very, very important strategy because things are not going to always go as planned. Because you sell a 35 delta call against your 85 delta leap, and that basically means there is a 35% chance that it is going to go in the money by the expiration date. But when it comes close to the expiration date, and when that becomes true, and then the price of the stock goes up higher than what you sold it at 455, then you have to make an adjustment. If you don't make an adjustment, suddenly you would have to buy back at a loss, or you would get assigned, then you have to pay and deal with it. You will get assigned at 455 and the current price is 460 or 65, and when the price of the stock keeps moving forward, unbeknown to you or unexpected by you, then you have to roll that over. That's a very, very important strategy that you should know when you're doing serious options trading, because the because position can move against you. It's not just because you may sell even 20 delta. 35 delta is what I normally recommend selling, but you must be prepared to move at 35 delta, where you get $3.90 premium. But if you go to 20 delta, you will get half the premium. Even that can go against you. Then you have to adjust. Anytime when you have position that moves against you, you have two types of adjustments. Actually, there are three. One is a vertical adjustment that I'm talking about, where you can move vertically on the same expiry date. You go to a different strike, either when you sell a vertical or you buy a vertical. But then you can do a calendar spread. You can do a same strike price from the current date to a future date, 2 weeks out, 1 week out, 1 month out, 2 months out, whatever it works out for you. So you can roll it on a calendar spread. The third option is what is generally talked about as a diagonal spread. A diagonal spread is you move out and then you also move to a different strike price. So if you're, let's say you are at 455, the price has moved to 465, and then if 465 will have, you are out by $10. So if you go, let us say, a month or more, a month and a few days, you see juicy premiums are available at $18, $19, like the $16, like that. So whatever has moved against you, you can go and collect this juicy premium by moving a diagonal. Sometimes from 455, you can probably move to 460 or 465, and you can still get either a break-even trade where you move favorably on the strike price, or you can even get a credit spread. You can even get a credit for moving to a higher price. Then you are now going to use 43 days rather than you have to wait for 43 more days rather than expiry coming in 2 days. So these are the three adjustments: vertical adjustment, calendar adjustment, and a diagonal adjustment. These are the three types of adjustments that are out there that you would have to employ every so often when a position moves against you, and you should be like, you should know them like the back of your hand, so that you can just move and close out the position and recover yourself when the thing moves against you. You need to know that strategy, so that don't be afraid when something happens in options trading, that what you expected did not happen. All of a sudden, you need to figure out. It could happen even when you sell a put with cash secured put. You may have, but you have no intention of buying the stock. You're just collecting premium for the cash that you have secured that with. But then it moved against you. Now you have to buy it. Then you can roll it over and then keep your position intact. The only thing is you lose time, but you don't lose your cash. So those are the ideas. So vertical spread, calendar spread, and diagonal spread. Those are the three things. Vertical spread is you go within the same strike period to a different, within the same expiry date, you go to a different strike, either it's a credit vertical or a debit vertical. If a debit vertical means you're going higher in the strike price on the call side. Credit vertical is when you go higher on the price on the call side and lower on the price on the put side. So same thing. So that's how it works. So you have to know the vertical strategies to make adjustments to your options position, calendar strategy to roll to a different date, and a diagonal where you go to a different strike at a different date so that you adjust your position. So that's
Bala,
what I want to talk about. Yeah, go ahead.
yeah, these spreads basically, not spreads, the words rolling and adjustments, two English words, basically are translating into two transactions. One is sell wherever you are, either in a good state or in a bad state. You decided to sell, that's transaction one. And then buy is a transaction two. So if these are two independent ones, even though we use these fancy words adjustments and rolling, but technically these are two completely two different transactions that are happening. The if a person is still interested in that particular instrument, then he is trying to like anyway continue to stay, whether it is two transactions or five transactions, it doesn't matter. But if the person is not interested, right, then the word rolling, the not interested meaning that if it is really going against you, that means you lost, let's say 50% or 40% of that. And then if you roll also, I mean, you already lost whatever you lost. I mean, what is that you are really gaining by rolling and doing another transaction and trying to like do another bet into the same thing? If you see it might not be working out, just walk out sometimes is a better thing, or still rolling makes sense.
It depends. Let me give you a time what I mean by goes against you. Let us say that Lockheed Martin, if you look at Lockheed Martin, in the last 3 days, it has jumped up like crazy. From about 390, it has moved out to 450. Let us say that you are in a lead call on Lockheed Martin and it is just jumping up. Now it is going in your favor. Let us say you have an 85 delta lead call on Lockheed Martin, which is expiring, let us say, a year from now, just to pick a number, right? Let's say you are sitting here, that is going to have an extraordinary gain on this jump. But let us say that you have also done a poor man's covered call on it, and you have sold on 14th March, you have sold a 35 delta call at some 460, or it may be even lower, 420 or so, and now you have to buy it back. Now, at this point in time, you have two choices. One choice is you still think the market is going to do better with Lockheed, so you don't want to get out of Lockheed. Lockheed is a good stock, war is coming, Lockheed is the way to be. Now it is going up. So now what you're going to do is you just the position that you bought, you sold at 35 delta at, say, let's say you sold it at 425, it's now at 455. For this $30, you know that there is a good stock, let us say. Now for this $30, you can just move out to, let us say, 43 days. You can get almost $20 of premium by moving out. Or if you want to move out, let's say 100 days, you are going to get a $30 premium, $27 premium. So you can almost cover all of your losses by moving out like that. So you may be better off moving out like that, because on the long end, on the leap call, you're going to make money, and on the covered call, you're losing money. It is the covered call side that you're adjusting. The leap call, you leave it alone because that's making money for you, and the covered call is the one you're adjusting. So just because I said it moves against you, that doesn't mean I'm saying that the stock has moved against you. The stock is still moving in favor for you, because on the long end you have sold a leap call, you have bought a leap call, but you have made a covered call, and that one is now worked against you because the stock has moved. So you have to make an adjustment. At that time, you want to roll. On the other hand, if it is, you don't believe it is going to go up, let us say, take a look at the chart and say, hey, 458 is the top, it is not going to go up from here, and whatever you have sold, you are willing to pay the losses by taking the profit from the other side. You want to close out the position, you can just close out the position, and whatever profits or loss you have made, and then you have moved on to another stock. You can obviously do that. But I'm just suggesting a situation where you still want to be in a position, but one leg of your transaction has gone bad. That one leg, you fix it up with a band-aid. That's what I'm suggesting here. This is
Okay,
fixing one leg with a little bandage.
got it, got it.
For that, you have to roll to a different date, a calendar roll, or a diagonal roll, or a vertical roll you have to do. Those are the rolling strategies that you have to think about. I don't know whether I make sense or not. I'm just talking.
No,
from
it's
No,
good.
I
It's
think
good. Actually, it makes sense when you now connected the leap to this in that scenario kind of example. Now this rolling starts to make sense. Otherwise, by itself, rolling or adjusting
Yeah,
might not
yes,
start to
yes,
make any sense at all. But
yes.
attached to something else, where hey, the vested interest is something else, and then this is just a byproduct of that, then started making sense.
Yeah.
yeah,
See,
another
one way,
aspect of rolling is the capital gains, right? Because you don't want to sell the stock, because if you are called, right, so you don't want to be you don't want to sell the stock because you want to keep it for like 1 year or something to avoid any short-term gain tax. So that is another place where you can use the rolling strategy.
yes. I think the rolling strategy could be one for tax purposes. One, you still want to be in the position, but you have to cover a leg that is not working for you. See, technically speaking, whenever you have a hedge, that is, you have a long call and a short call, or a long put and a short put, whenever you have two ends of the strategy, and when the stock moves one way or the other, only one of the two legs is going to make money for you. the other leg is going to lose money, right? So that's
Right.
why typically in these strategies, you want to be one leg in the money and the other leg out of the money, so that the out of the money leg, even if it moves, you have sufficient room there before the expiry date for you to come clear, and then you can just collect the covered call. But if both the legs are coming into the money and one leg is both are in one area, then you have to make an adjustment so that you come to an optimal position. Let us say, for the sake of argument, your optimal position is 85 delta on the long and 35 delta on the short. Let us say, for the sake of argument, that's what your strategy is. Now you get into that strategy, when the price moves, delta is also going to move. As many of you know, delta is the Greek that gives you the percentage probability of being in the money and how much it moves per dollar move of the stock. But there is a gamma. The gamma is how it moves delta. So as the dollar moves, the delta itself is going to change. So the 85, you may have got into the position at 85.35, but then if the stock moves by $5, all of a sudden your delta position is going to be like 90.45. All of a sudden it would have changed. So the optimality of your position is changed. Whatever be it, whether you are in a zebra or whether you are on an iron condor or whether you are on a 85-35 strategy that I used to talk about, or any other strategy that you have employed to get into the options trading, whenever you have a hedged position where you have a long and a short, when the price moves, both of them are going to move, and one of them is going to hit a wall, and you have got to make an adjustment. That adjustment is what I'm talking about.
Yep. Yep. Nari, you mentioned that from the taxation standpoint, when you roll, you can avoid the taxes, especially. That means that it is not considered as two transactions, it is considered as one transaction in that scenario. In my reference, I was saying all these rollings are technically two transactions and two independent ones. That means that one you sell, you will be hit with the taxation anyway, is the way I was thinking.
I was talking about a case, right? You have a stock and you sell a covered call, right? And then so it went against you, so they are asking for the stock, right? So, but if you don't want to sell the stock, because if you sell the stock immediately, whatever appreciation you have to pay tax, short-term gain tax.
Okay.
Whereas if you keep rolling it for 12 months, then you don't have to pay the short-term capital gains. You can only pay the long-term capital gains. That's what I was
Okay.
saying.
Got you. You're just postponing the event. Got it.
Yeah, postponing the event if possible.
Yeah.
Okay, no, I think this is great, Bala. Thank you very much for doing this.
Questions? Anybody has any other questions? I mean, that's all I wanted to cover. I really wanted to kind of go over
Yeah, no, this
more
is
like
very
a
useful.
whiteboard kind of discussion, and I am happy that everybody contributed. It's very nice. It's not a one-way traffic. I really appreciate that.
Because see, this is not an introduction class, right? Only people who know attending.
Yeah, but I do believe that options is a very good way to make money, but you must be very careful. You must only bet a small
Yeah, you
portion of
should
your
know
investment
what
and
you're
all
doing.
that stuff. But
Yep.
with the proper strategies, you can certainly make money, and you have to know these basics.
Yep. Okay, thanks a lot, Bala. Have a good trip.
Thank you very much for everybody for your time. I appreciate it. If you have any